Welcome back to the Behind the Well Show. I'm your host, Roger Abel, back with Elias Randall. Elias, everybody's favorite day of the year was last week, also known as tax time. But the reason I bring it up, found a really cool article on Forbes. And I know I put it in the outline, but it's titled How Income Taxes Got Americans Hooked on Cocktails.
How did they?
You're the happy hour specialist. You should tell me. Did you read it?
This one I could not get to open. I don't know why. Actually, every time I opened it, it took me to a different article, so I couldn't find it. But if you tell me what's going on with it, I still don't know how income tax got people hooked on cocktails unless...
I don't know. I think it's catchy.
Like, I don't want to pay this bill, so I'm going to go have a drink.
No, I actually asked Molly about it, but it talks a lot about how in 1909, there was no income tax in America. That's when income tax was established. And up until then, we relied on tariffs, which we've heard a lot of talk about that recently in the news. Is, we could get rid of income tax and go to a tariff-based system, primarily because this is how it was done back in 1909. But that said, there was a lot of revenue that was generated from alcohol being imported into the United States. Well, once we established the income tax system in 1919, Prohibition came about because we didn't need that tax revenue anymore. And Prohibition came about.
Prohibition, what a mistake.
Well, they thought at the time that it was going to reduce crime, reduce violent crime, reduce all this stuff, right?
Right, but it's America.
It had the opposite effect, like complete opposite effect.
Right.
And then eventually
drinking alcohol is illegal, so a black market started, and bootlegging and organized crime didn't start. But yeah, what a not a good idea.
Well,
not a good idea.
It accelerated. It just accelerated the crime. But what eventually happened is, Prohibition ended, and that gave rise to, economic activity from the alcohol industry in America, because now you had all these bootleggers that were able to, and distilleries that are able to start to legalize this. And I had no idea it was this big. Today, alcohol contributes $1 trillion in economic activity in America.
That's insane.
That's
I think
a
only
lot.
about 40% of Americans actually drink alcohol.
It's responsible for 1.58% of the total gross domestic product of the United States. So one avenue. And in 2024, $58 billion in tax revenue from the sale of alcohol. But what happened, and I think this is kind of fun, is tax day cocktails were kind of invented. Like, the cocktails we think of today came out of this period of time. So I thought it'd be fun to hit on a couple of the most popular tax day cocktails. And we think of tax day now as, when I saw this, I'm like, hey, people believe it's tax day, I need to have a cocktail. So here's a couple of the most popular.
Is that what people believe?
I believe. Well, it's funny though. I had a client call me this morning, and they didn't realize we were withholding federal income taxes from an IRA distribution, which they were happy about. And I go, well, I haven't done mine yet. I filed an extension. He goes, yeah, me too. I said, we get to deal with this on September 15th. So some people get to do taxes year round if you file an extension. But a couple of the popular drinks that came out of Prohibition and the legalization of alcohol, I'm going to throw them out there. One is called, because you haven't pulled this up, one is a variation on the Bronx, which is a perfect martini with orange juice added. Have you ever
I've never had a martini with orange juice.
Did you used to be a bartender?
Yes.
Yeah, that's why I thought. So it's 1.5 ounces of gin, 0.5 ounces of vermouth. So that's just classic of dry vermouth, 0.5 ounce of sweet vermouth, 1 ounce of orange juice, bitters, and a little bit of orange. That doesn't really sound that great.
I actually think it sounds good.
You do?
Yeah.
All right. I'll take it from you.
Gin martinis are hard to drink. That one they might put enough sweet stuff in there that it's not too terrible.
So another really popular cocktail that came out, and most of these cocktails were created to mask the chemical taste because the alcohol wasn't really that good back then. You know, gin was originally coined bathtub gin because that's how they were making it.
Right.
So they'd add sweeteners and all this stuff to make it taste better. But the bee's knees was a really popular Prohibition era cocktail, primarily because the honey and the sugar and everything masked the bad quality of alcohol. So that's another really famous cocktail that came out of Prohibition. And that's just gin, lemon juice, and honey.
That sounds good.
That guarantee you that's good.
I'd probably rather have vodka with it instead of gin, but
I love the expert bartender. And then a sidecar. That's another really popular cocktail that came out. That's cognac, orange liqueur, and lemon juice.
it's probably pretty sweet.
I don't know about the cognac.
I don't know that I've ever had a serving of it.
Of cognac?
Yeah, I don't know that I've ever actually drank any of that.
So I have. I remember my grandma and grandpa, they'd have on the counter, they had a big thing of cognac, and every night that was their nightcap. Just a little glass of cognac. And I actually brought that up. My grandma's 95. I said, Grandma, do you remember that you and Grandpa Don would always have a little glass of cognac before bed every night? So that's how I got familiar with that. But either way, cheers to the end of tax season if you're done. Most people are pretty happy to get it over with. It's not the most fun time of year seeing where your money went. But cheers to the tax day cocktail. If anybody wants these cocktails, send us a message at btwellshow.com and we can get you the recipe. But I just thought it was a fun article. And I didn't really realize the economic activity that alcohol generated. And what's ironic though today is I think there's been a drastic drop in alcohol sales, if I'm not correct.
I don't know about drastic. I do. Yes, alcohol sales have been declining.
I wonder what retail sales are down 5%, although bar spending has remained relatively stable.
I think I know the answer to that.
U.S. drinking rate, this is from Gallup, U.S. drinking rate at new lows as alcohol concern surge. I think young kids don't drink alcohol today.
That has a lot to do with it.
Yeah, and I think also people are realizing what it does to your health.
Yeah.
And probably the drive for no carb, low sugars. Like if you think about all those alcoholic drinks we just talked about, every one, what was in it? Honey, sugar, like a bunch of sweeteners.
Right. Well, even if you were to drink liquor straight, the alcohol is going to be converted into sugar.
Here's what's interesting, though. I just pulled this up from NBC. Spending at bars is on the rise, while retail alcohol sales are falling.
Is that just because it's more expensive?
I don't know. I almost wonder, is there a shift? Like there was a time where you bought alcohol, you drank it at home, and now people want the social interaction.
Here's my speculation that I think the at-home drinking has slowed down, but people that go to happy hour, go to the bar, go to socialize, those drinks are still being sold and consumed. But that same person that might go home and have a couple more beers is maybe not doing that anymore for health reasons or sleep reasons or other reasons.
Well, spending at bars, this could be the other side of it. The rise of the mocktail, the non-alcoholic cocktail. Like there's a lot. So I just pulled in this article.
Yeah, do NA beers count towards alcohol sales?
Well, bar sales.
Towards bar sales.
Right.
Right. That's the other thing. There's a lot of really good non-alcoholic beers now where 10 years ago to drink an NA beer, you had to drink a Coors or a Heineken NA, at least around here. Well, now you can get IPAs. You can basically get every style of beer without alcohol, and they all are pretty good for the most part.
So we always keep quite a few NA beers around. So about a year ago, Megan went to a party and grabbed a couple Michelob Ultras to take to this party. She's like, man, I had 3 beers and I didn't really, I didn't get a buzz or anything. I'm like, well, yeah, those are non-alcoholic. So we were sitting around the lake house the other night, our first time down, and she had a beer. She goes, and, it'd been there since the last time we were there. She goes, I think the beer might be bad. It kind of tastes funny. I looked, I said, yep, you've got a non-alcoholic one. It's not the same. It wasn't like it was bad. She just thought there was something like a little off about it. I'm like, well, yeah, you grabbed the non-alcoholic one. But for the most part, most of the NAs are pretty darn good. Like Athletic
there's
Light.
a few brands out there that I like. And I'm not opposed to having an NA. I keep them in the garage fridge all summer because we have a pool, right? Well, it's easy to have too many sitting by your pool all day. So I always like having the NAs around.
Well, you've been boating with me. That's why I bring on the boat.
Yeah, you can have a beer and you're not getting out of control, I guess, or having too much where you're...
Yeah. And I think sometimes there's certain foods that I like to have a beer with certain foods. But I don't always
want would that be? Chicken wings?
Yeah. Pizza. I mean, staples of my diet. But, do you want to add the 300 or 400 calories of beers with it too?
Yes.
I was at a neighbor's the other day, and they offered me a beer, and the options were Easy Eddie, and they were all heavy beers. I didn't want to turn them down. I'm like, man, this is 200 calories and just a bunch of, which it's the beers I used to drink all the time. But I slowly sipped one back. By the time I was done, I'm like, man, I'm full. One beer. He goes, want another one? I'm like, I think I got to go.
What'd you have?
An Easy Eddie.
Those are pretty good.
They're great. But when you don't drink those heavy beers all the time,
I guess that's typically what I have when I do
you
have
drink
a
Easy
beer.
Eddie. No, I always drink something super light.
Yeah, I don't drink a whole lot of light beer.
I used to love those heavy beers. I was having a discussion with a client the other day about how wealthy people kind of accumulate their money. And I think there's this fallacy around how people get wealthy. They just assume, the outside general public just assumes they had a bunch of money and they threw it into something at one time. They don't think they're taking the same steps. So I thought it'd be good to kind of cover 6 ways that wealthy people or rich people actually find ways to save money that everybody can apply to their daily life, because they're not doing it differently. They're doing it in a larger fashion, but they're applying the same principles as we would apply to any individual investor that we were working with. And I think, as I think about this, the number one thing that stands out of what affluent people do versus, general public is they make it a priority to automate their savings and investments. And I know we talk about this on this show a lot. Automation of savings and investments leads to literally the best results we see.
Why is that?
Because it's consistent. There's a couple things happen. One, it happens, right? When it's automated, it just happens all the time. But 2, there's no feelings, there's no decision-making as part of it. It's just, it comes out the same time or same week or however they do it. It's just regular and consistent. And I understand most individual investors are doing a 401k, but the next step that people tell people get really wealthy, they're doing it with outside investments. They're doing a brokerage account. They're putting money in every single week or every 2 weeks when they get paid. And in addition to that, they strategically increase how much they're putting in.
The key for people doing this, the automatic saving and investing, here's the key. you just said it's regular and consistent, right? But you're also you have made your budget a priority where when it's automatic, it goes into the account, right? It never, or maybe goes from your checking account to your investment account. Maybe goes from your paycheck to your 401k. You can't spend that money after you do it. So it's also, you're kind of putting a barrier in too, where I prioritize this. I'm going to save it before I have a chance to spend it. And you're paying yourself first. So I think the bottom line is, if it's automatic and consistent, that's typically how you're going to get the best result. And more people, you can go out there and look on YouTube, and you're going to hear all this stuff about how to get wealthy and how the rich do it and a lot of things. At the end of the day, most people that have enough wealth to be financially independent in America have done it through retirement savings and being smart investors.
And coincidentally enough, the 401k plan, which is where most people hold their wealth, utilizes those two things: regular and consistent, automated. There's a reason that's where everybody has their money.
And it's fairly easy. If you set up a 401k, for example, if you set up a pretty good contribution amount, I'm not talking, I do 3% so I can get 3%. Like, you put in 10 to 15% of your income. Let's say you're 23 and you started doing that. Well, all of a sudden someday you got $100,000 in this account. And you're thinking, well, that was pretty easy. Because really, it can be easy if it's regular and consistent.
For sure. Well, it leads to the second high impact thing people can do, and it's prioritizing strategic investments. Here's the key to that. You're prioritizing tax advantaged accounts like 401ks, Roth IRAs, HSA accounts. They're maximizing those because they provide the most benefit long-term from a tax standpoint. They're just not doing this willy-nilly. They're sitting down and looking at their situation today. They set goals and priorities for the future. And then they're massaging and figuring out which of these types of tax strategies work best for me. In fact, I got a message or an email from a friend of mine, not a client, but wants to be a client, and just said, hey, I really need to start working on some tax strategies. He's a pretty high income earner. He's making $600,000-$700,000 a year. And he's about my age, 47. He said, I really need to start thinking about how I strategically put this money away. He's went from just accumulating to now adding strategy to it. And it's interesting because I saw him at Home Depot like 4 or 5 months ago. And we started talking about this. And today I got the message, hey, let's sit down and put together a strategy that high income earners would use to maximize my wealth long term. And that's the second step, is prioritizing, strategic type investments.
Wealthy people also understand the power of compounding too. You just talked about tax advantaged accounts. Well, also your money compounding and growing. And really what's happening at that point is your money's working for you. You hear that phrase all the time, right? Like, you got to put your money to work. Well, investment accounts, and especially retirement accounts, can make it very easy. There are other ways to build wealth too, right? In real estate or starting a business. Those are much more difficult paths to get there, where as simple as, I regularly and consistently invest my money. I buy good investments. I have a diversified portfolio. It's compounding and growing for me. It's almost the easy button in a way to end up having some level of wealth at some point in the future.
Another common way we see people accumulate wealth is strategic tax planning, engaging financial advisors, attorneys, CPAs to figure out what the optimal way to plan is long term. And here's an underlooked one that I think people don't think about. As a society, we look at items that we're going to purchase, and there's typically for a similar item, there's an array of prices. One thing I found is that wealthy individuals will prioritize buying quality over the cheapest price. And the reason they do that is they've learned over time that the cheapest price typically leads to replacement versus repair. I can't tell you how many things I personally bought that it was the lowest price, that a year later, I'm actually going and buying the better quality item. If I had just bought the right thing right away, I wouldn't have had to replace it. I could have repaired it. And that always goes back.
You got to buy it twice. You get to buy it twice.
So it's nice. We buy it twice because it's going to be nice. Yep. But, I'm sure you've done that. You're like, oh, yeah, I'm going to go buy that. And it's not what you thought it was. You finally upgrade to the better item. And
I actually did that this last week.
What'd you buy that?
New lawnmower.
So you bought a cheap one, and then you're like, I'm just going to get a good one.
Oh, dude, I've been running a cheap one I've been beating on this mower for 6 years. Bought it for $400. It's an old John Deere lawn tractor. It runs great. It started the first time I put gas in it this spring. But it's technically too small for our yard. It does need a new ignition because it doesn't technically turn on every time you turn the key, but eventually it will turn on. So I went and bought a new lawnmower, and I didn't buy a used one. I didn't buy a cheap one.
What brand?
I bought a John Deere from one of the local dealers around here.
So, great point. You bought a John Deere, so you bought quality.
Yeah.
The guy, how old's the lawnmower you just replaced? Like 30 years?
It might, well, probably 25. I think it was built in 98 or 99.
There you go. But the person who originally bought quality. They say what you want, but how many items last 30 plus years?
Well, and what's crazy about it, it's actually like a big box store mower that John Deere made to just sell.
Sears probably.
So it's not even of their products at this time was the worst one they were making. But the thing's a tank and it runs great. It's not easy to work on. There's definitely setbacks to it. But yeah, I got a little bit nicer one, a 0 turn. So those are more expensive.
Is it like when you sit on like this, or is it like a tractor?
No, 0 turn.
Oh,
so you
that's
sit
cool.
and you drive with I don't know what those handles are called, but drive with those. And I wanted to get it from a local place, and I wanted to get it from a dealer so they can come for $50 round trip. They'll come pick it up at my house, take it and service it and bring it back. So I'm paying for some convenience of ongoing maintenance too.
So that's a great example. Wealthy people buy back their time. They're willing to pay more for good customer service. It's not about the lowest price option, because the lowest price option equals no service.
Yeah, because I could have, and I thought about it, I could have bought a little bit bigger mower from a different, there's a small business in this area, really good reputation. I've had friends buy mowers there, so I was thinking about doing that. But there's no they're not going to come pick your stuff up. You got to take it to them. Well, then I had to buy a trailer, and I don't have a vehicle to pull the trailer, and it's further away from my house. So I actually, for the money I spent, could have got a nicer, just pure lawnmower, but I wanted some convenience with it. I'm growing up. You're maturing.
Growing up. You're maturing into
I stopped myself from buying another $400 lawnmower that I could just beat up and run as hard as I want and don't care about.
There's part of me that still sometimes can't get away. Like, I still like to buy the bargain, or I don't really like to buy new that much. But sometimes it's worth it. Like vehicles, we usually get new. But, I bought a tractor recently. It's a 1998 John Deere. But I got the right deal for it. Like, I expected to needed new tires, so I put new tires on. I expected to have to do some repairs on it. But for what I use it for, probably last another 20 plus years.
Oh, that's another thing on here on the 6 things, valuing maintenance over replacement. Okay, so I kind of just went with replacement.
Yeah,
but I'm actually going to get this serviced ongoing. So I guess I technically am valuing the maintenance, because part of it was, because if I have to take it, it's never going to get done. And then I'm going to do it myself, and it's probably not going to be done exactly right. But if I pay them to come get it and do it, I know it'll be done right.
Well, no, I think you did value the repair over replacement, because you bought something you're not going to have to replace probably for another 20 years.
I sure hope so.
You know, if you went and bought the cheapest zero-turn mower, the lifespan of that mower is likely shorter than the lifespan of that John Deere.
I would think. I would hope.
And, you know, who knows? When a lot of times the cheaper brands, they're made in other countries. Well, what if they go out of business and now there's no parts? Like, that's happened. Like in the tractor world, that's happened. These places go out of business, now you can't get parts. You're stuck with some obscure piece of machinery that you can't fix. Guess who's not going anywhere likely? John Deere.
Yeah, they're not going.
You're going to find parts for the John Deere. I think another ironic thing that's happened, Elias, is, not to totally shift gears, but the S&P 500 has erased all of the losses from the Iran war. We hit all-time highs last Friday. We're filming this on a Monday, full disclosure. Last Friday, we hit all-time highs again in stock markets. People are feeling good. I think this just goes to show why long-term investors who just stay the course and tune out the noise are successful.
I've had a couple people recently ask me, have you been getting a lot of client phone calls?
With zero.
Off the high. What were we from? What were we off the high? Was it
10?
It was.
It hit 63.80. I think it was March 1st. It was 63.80. And it was a little over 7,000. We're trading 7,100 on the S&P.
Okay, so saying 10 is fair.
Yeah.
Off the
I think
high.
it was correction territory.
Right. Which I think I don't know that that's my take, because we didn't get a lot of phone calls. I think
I didn't get any.
I got zero. I think our clients they viewed it the way you're supposed to. This is normal. It's normal for the stock market to fluctuate, and especially a correction, which is typically 10 to 15%. Once it goes over 10, that's correction, right?
Correct.
Right. So in the year-to-date return was less than that. What was it, down like 5 or 6 year-to-date at one point?
We're up 3.53% year-to-date now.
Right.
So just to put that in perspective, that's on pace for an 11% annualized gain.
And I like this takeaway from here. Here's why long-term investors who stayed the course are being rewarded, because that's what happens. And it continues to happen, and it keeps happening. I would assume 5 years ago we talked about how people with good investment behavior are rewarded when it turns around. I'm sure 10 years from now we'll be saying the same thing. So the important thing to know is when chaos happens, you should have the confidence in your plan, confidence in your portfolio that it's going to work out. And I don't think we had anyone, I know, like, because we run our withdrawal strategies, right, for clients taking money. We don't have any clients that had to sell any investments at a loss to provide their income.
We did raise cash flow Friday for some people.
That was a good time to do it.
Yeah. When the market's back to all-time highs and you know you have an expense, that's when you start to raise some cash. So, question, and you can tell me what you think. Would you agree that Tom Lee's one of our favorite analysts to follow?
Yes.
Okay. Tom Lee runs FundStrat, full disclosure. They provide research to most of the hedge funds on Wall Street, a lot of the investment firms. We like Tom Lee because he's a half glass full guy. Like, he focuses on the positive. I mean, probably because the market's up 80% of the time, so why wouldn't you? But his end of year S&P target is 7,700.
That's pretty rich from here, but yeah.
Okay, so and no one's holding you to this.
Okay.
Do you think we'll hit it? Yes or no?
Yes, I do. I do believe so.
I do too.
I think it'll be. I expect more volatility like we've had the last couple of years. I won't be that surprised. Yeah, I think that'll happen. I'm not making a hard prediction though. I guess I just kind of did.
Tom Lee, the last time he part of his outlook for 2026 was there will be a pretty good correction, if not a bear market, but then we'll get back to 7,700. And I think that revolves around the idea of volatility and geopolitical risk that's out there. But I think we get to 7,700.
So he was on CNBC the other day, and in March he did, which good for him because he will go on CNBC and have convictions in his outlooks. That's what he should do, right? He's a research analyst, running a research firm. Well, back in March, he was on there saying S&P will recover by the end of March. Well, then they were hammering on him because it took 2 weeks longer. Then the end of March, he's like, "Yep, you're right. I was wrong."
Sorry,
over 2 weeks.
It was April 17th instead.
Right. I just thought that was funny, and I've seen him do that before. He just takes it on the chin and, yeah, here's my outlook. Are you still at 7,700 by the end of the year? Yep.
Well, on April 8th, they interviewed him. He said the market's bottomed on April 8th. Stocks are headed to all-time highs. Well, he was right. But with anything...
So that one, he was right then.
Yeah.
Okay.
With anything, though,
these are
predictions.
He did miss his end of March target.
Right. But with anything, these are predictions. They're fun to look at. Most people aren't right. You know, he's in a situation where the market has trended higher for the better part of 100 years. So he likely will be right at some point. And I think that's why just staying the course and not even worrying about what's going to happen is really the best thing to do. Can't control it. I had this talk with my wife this morning. I ran a couple scenarios like based on our savings rate. What's the worst case scenario? What's the best case scenario? What's the average? She goes, "Do you think the worst case will happen?" I go, "I don't know." I said, all we can control is how much we put in every month or week. That's the only thing you can control. So you let the chips where they lie. If you plan for the worst and you get the best, will you be happy? Yeah. Like I said, this worst case scenario, would you be happy? Would you be okay if that happened? Yeah, that'd be fine. Well, what if the best case scenario happened? That would be wild. That was her exact words. So I think, but when we talk to clients about it, or we talk on the show about it, we're doing the same thing. I'm not doing different planning than other people. You know how my philosophy, I do it every single week, but I'm still doing projections for myself and running a plan and trying to say, hey, what is the savings rate to get to where I want to go? Because that gives me permission to go do other things with my money versus just have to save more, like get to a point where it works out on a worst case scenario. And if it's better, it's better.
I was able to buy my lawnmower because of all that. No, I'm kidding. It wasn't that big a deal. But yes, I do the same thing. I have in the software, I have a program for my family, and I like to keep an eye on it. At least once or twice a year, I go in there and make sure, okay, are we on track for what we want to be on track for?
I think that's the takeaway from this show.
What?
Less emotion, regular and consistent. Make sure you know your savings rate.
That's too easy, Coach.
There you
That's
go.
just the fundamentals.
Put me in the
Fundamentals aren't fun.
Hey, congrats on the mower.
Thank you. I'm excited to drive it.
I bet. All new toys like that are fun to get. So congrats on the mower.
I know. I actually so Maddie and I kind of split lawn mowing duty in the summers because she likes to mow. I told her, you're going to have a hard time, especially this first summer, getting on that new mower because I'm excited to drive it.
What'd she say?
She just laughed. But she likes to do it because, you're out in the sun, and she does. Some people enjoy Mowing is kind of a fun activity. I mean, it can drag on, but you can see her work as you go. I think that's kind of the pleasing thing about it.
Sure.
So we'll see. She's never driven a zero turn, so that'll be the first step. Is I got to teach her how to drive it. Should be good.
Awesome. Well, congrats on the mower. I want to thank everybody for listening. If you're looking for help getting your financial plan started, figuring out what your unique savings rate is, or just kind of how we do this, go to btwellshow.com. Be happy to get you in touch with one of our advisors to help you out. Want to thank everybody for listening, and hopefully you keep tuning in.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Premier Investments and Wealth Management and LPL Financial do not provide tax advice. Please consult your tax professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. There's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. Dollar cost averaging involves continuous investment in securities regardless of fluctuations in price levels. Investors should consider their ability to continue purchasing through periods of low price levels. Such a plan does not assure a profit and does not protect against loss in declining markets. A plan participant leaving an employer typically has 4 options and may engage in a combination of these options, each choice offering advantages and disadvantages. Those options include leave the money in their former employer's plan if permitted, roll over the assets to their new employer's plan if one is available and rollovers are permitted, roll over to an IRA, or cash out the account value. Consult your tax professional about eligibility to Roth and traditional IRA contributions. Contributions and earnings in a Roth IRA can be withdrawn without paying taxes and penalties if the account owner is at least 59.5 and has held their Roth IRA for at least 5 years. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of the conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a minimum distribution, RMD, in the year you convert, you must do so before converting to a Roth IRA.